If you're only just starting to get into investing, you might be wondering, where do you even begin to look for stocks to buy? And how do you even choose stocks properly? Being a beginner at anything always has this pressure of doing things right the first time. Though it's ideal to be very careful when you just started out, there's no shame in making a few mistakes. After all, that's only the first step to being good at something. Moreover, you'll learn and grow to be wiser. But it's still better to avoid mistakes, especially as beginners. That way you can prevent something unfortunate from happening that might have a bigger effect in your future, especially as stock investors. That is why we're here to help you out. For first-timers, it can be easy to get lost in the hows and whys of doing things. Hence, we're going to answer all of those questions for you so you know what to do next. In this video, we're going to tackle more about investing and looking for the right stocks to invest in, as well as how to be better at choosing them. We will also be giving you tips and advice, so stick around and let's learn more about stock investing, shall we? Hey, welcome to Stock Market Mate. Today, we'll talk about how to pick stocks for beginners. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Why invest in stocks? Why do we invest? Everyone probably has different reasons, but ultimately we're all after one thing: making a profit. Most people like to invest to grow their money into hefty sums, so that when they retire, they'll have already made so much money to leave to their children or their grandchildren. Either that, or they really just love to earn more money that they can count. Whatever the case, the point is, investing is a great way to be rich. Many rich people invest to be even more rich, and most of them don't invest in just random things, but rather they invest in shares such as individual stocks, company ownership. Furthermore, the stock market can be a very beneficial part of your investment portfolio. Your investment portfolio contains all of your financial investments such as stocks, bonds, commodities, and cash equivalents, including closed-end funds and ETFs. Additionally, purchasing stocks in either one or many different companies will likely help you build your savings than if you aren't investing at all. You'll also be able to maximize your investment income while protecting your money from inflation and taxes. Investing in stocks is actually not as intimidating as it sounds. With knowledge and practice, you can confidently put your money out there without fearing it would decrease or worse, deplete. A good strategy for investing is figuring out first what you need and don't need to do before you decide on anything. With good strategy, anyone can make money in the stock market. There's actually no need to be a genius on this topic to pull it off. You just have to recognize the advantages and risks when investing in order to avoid creating strategies that are faulty, meaning they have room for so many mistakes. Additionally, you need to be mindful of how and what you're going to spend your money on in order to avoid wasting it. So without further ado, let's discuss some of the things that you need to remember when you're planning on investing. Firstly, we'd like to encourage everyone to be very cautious in choosing individual stocks. Investing in individual stocks is a good thing because of index funds. Index funds are a type of ETF or exchange-traded funds that track underlying investments by following certain preset rules. It's important to choose one wisely because when done right, you can ultimately grow your money more than you can ever imagine. For example, Vanguard offers one specific fund called VTSAX, or Vanguard Total Stock Market Index Fund Admiral Shares. The current price of one share of VTSAX is $74.55. This means that for $75, you would own 3,575 publicly traded companies in the US. To add to that, the stock also has global exposure. All you have to do is invest as much as you can every single month into this fund. In the distant future, when you're ready for retirement, you're probably going to have a great investment portfolio by then. Next, let's talk about probability. Not long ago, researchers did a study on which pick stocks would perform better in the market. Some are randomly picked by a simulation, and the others are carefully picked by experts. Strangely enough, they found that randomness beat human strategy. Sounds kind of weird, doesn't it? But this doesn't necessarily mean you can't beat this. There's a way to outsmart the scientific result. How it is done will be discussed in the next section of this video. Another thing you need to keep in mind is that when picking stocks, getting help from experts, such as fund managers, might not actually be that effective. The reason for this is that what they do is to just mostly sign you up for the commissions and fees they produce by holding onto your account. They don't necessarily guarantee you the results that you need for when you're investing. Hence, they might not be able to help you out that much. And those are just some of the important things you need to learn about investing strategies. Let's move on to the next one. On picking the right stocks. Now that you know the things you should keep in mind before deciding on a stock investment, we're going to proceed to the next part, which is examining the factors that influence the value of a company. Keep in mind that investing in long-term value stocks is the best method of consistently making money. The first thing that we're going to talk about is something called quantitative analysis. Investors use this method to determine the real value of a company. Now, real value is basically just the stock price of a company, and the real value that they supposedly look at aren't actually the real price. They are instead usually just expectations. This method specifically looks at things such as income statements, balance sheets, and the like. These terms are generally the fundamentals of a company. To find out more about them, you can simply go on Google and make a quick search, or you can check out a business's quarterly earnings report. In addition, you can also use a site called Simply Safe Dividends. They are a website that provides portfolio tools that are easy to use for anyone starting on their investment portfolios. They're a great tool as well for looking at the statistics for all these terms. Take note that the site is, however, quite expensive, so they might not be that ideal if you're just starting out on investing. Though like every site, they do have a free trial where you can use it through signing up. They will allow you to freely access their services for 2 weeks. Likewise, there's a great book that you can check out and read to learn more about quantitative analysis. It's called The Intelligent Investor by Benjamin Graham. It provides a more in-depth explanation on quantitative analysis, which we can guarantee will be very helpful. The next method in how to look at a company's value is through qualitative analysis. Unlike quantitative analysis, qualitative analysis focuses on a company's characteristics rather than its numbers. When quantitatively evaluating a business, you can ask things such as, is a company dull? Is it interesting? Are customers continually purchasing its product? Through answering these questions, you can learn more about a company's value. To further learn about qualitative analysis, you can read more about it in a book called One Up on Wall Street by Peter Lynch. All things considered, we can take a look at both qualitative and quantitative analysis and at the same time can find that the stock price is too low. Also that immediately purchasing them won't really ensure that the investment will earn you money right away. However, you can be assured that the value you used in bringing it out will not cause you to lose money. This is called the DDM analysis or the dividend discount model analysis. Before you know it, when stock prices match reality, then profit comes. Basically, this is a niche that exists in the stock market. That is to say, the price-to-risk ratio is more favorable. Investing in stocks surely will have its ups and downs, but this must not discourage you, as we're sure you'll get better as you gain more experiences in the future. But for now, we hope we were able to provide you with more insight on stock selection, preparing you to start your own investment journey. And that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!